I'm Scarlet. This is ETF IQ, where we focus on the access, risks, and rewards offered by exchange-traded funds. Green is the new black. BlackRock identifies climate change as a risk, and the firm's environmentally friendly funds see record inflows of cash. Building a moat. Jan van Eck tells us how he created an ETF with a long-term sustainable advantage. It's taking money away from active mutual funds. And ringing in the year of the rat. As China celebrates the new year, we've got a tale about an ETF that helps you preserve wealth. Now, whether you embrace or reject ETFs, they're here to stay. So let's get started with Bloomberg's ETF whiz, Eric Balchunas, who walks us through the recent fund flows. What do we see?
Thank you, Scarlet. Yeah, so I'm excited. This leaderboard is a little unusual. We've had the same kind of leaderboard for weeks straight. So here at the top, we've got an ESG ETF, and on the fourth place. I'll get to that in a minute. Also, gold up here is interesting, and small caps. And on the outflows, you do see Qs and SPY. So I do see a little risk-off action here, maybe some profit taking. But let's just really pay attention to ESG because it's so unusual. Let's look at ESG ETFs and their monthly flows, and I'll show you how wild. Those two ETFs are basically already pushing ESG ETFs to record flows. We still got a couple weeks left. Now, this isn't a bunch of people who read Larry Fink's letter and are rushing in to buy ESG. It's BlackRock itself. After Larry Fink talked about getting more concerned about these kind of issues, they put these funds into their models, which advisors use. So that was instant money into those. Now, let's just say this is good flows, but it's still small time. ESG ETFs only have 20 billion, so they're pretty small. This is low vol in value. So you see ESG is still very small, 0.5% of the assets, and half of it is seed money, prior capital commitments and whatnot. But Scarlett, you can't deny that this is a good month for ESG. It's a big, everybody's talking about it, so it's a good sign, but again, there is still a very underwhelming category.
Right, but big growth rates given a small base. All right, for this week's roundtable, we've got David Perlman, ETF strategist at UBS Global Wealth Management, and Katie Greifeld making her debut on ETF IQ. She's a cross-asset reporter for Bloomberg News. David, let me start with you because, as Eric mentioned, climate change is topic number one these days, certainly at Davos, and it's become a real defining issue. Bloomberg, of course, is all over it with the launch of our new coverage called Bloomberg Green. I want to get your take because we know in the ETF world, there's no shortage of different ETF funds that investors can buy into. What kind of demand do you see from your clients for these products?
Sure. So at UBS, we do expect demand for sustainable solutions to increase over the coming years, just given demographic changes and concerns over the environment. But as Eric pointed out, the adoption in the ETF space has been pretty slow, at least in the U.S. markets. And there are just a number of challenges that I think present a headwind. One of which is that you're dealing with consumer preferences, and there's no consensus as to what should or should not be included in these portfolios. And just the other day, I was asked by an investor for a client, they wanted a carbon-free and bank-free solution, which is really the first time I've ever gotten that mix of requests for a sustainable strategy. So, and ETFs have all these benefits, the wrapper itself, but mass customization, right? It's not one of them, like with any pooled vehicle.
That's a great point. Katie, Eric mentioned how BlackRock's ESG funds have been taking in record amounts of cash. Give us some more context around the big numbers here. Certainly they're impressive.
Right, so BlackRock CEO Larry Fink kicked that all off. He said in his annual letter that climate change could upend global finance and that BlackRock's going to work to address that issue. Part of that includes doubling its sustainable ETF lineup to about 150. And these inflows we've seen this past week, as Eric said, it might be BlackRock just moving around its own money, but it's not just Larry Fink. We heard from the Bank of International Settlements, who warned that green swan events triggered by climate change could set off the next global financial crisis. So it's going to be interesting to see if these inflows persist as, that drumbeat just grows louder.
Dave, you write about ETFs for a large base of financial advisors, and one of your themes is, hey, the U.S. has had a nice run, but let's think about going overseas. And we've heard this all year last year, but international's pretty much lagged. Talk about why you think the time is now to move and where specifically.
So if you look at the global equity markets, the U.S. equity allocation is about 55%. And most investors in the U.S. hold much higher weightings to the U.S. And we're going on 10 plus years of U.S. equity outperformance. So they've been rewarded for that positioning. but 10 plus years of outperformance, it's rarely sustained. So we think it's a really good time to revisit your allocations to international equities. Right now in our wealth management models, we're overweight emerging market equities, and really for three main reasons. One, it's just cheaper valuations than you're getting in the US. Two, we expect faster earnings growth. And three, when you have the trade deal, like we expect more of those benefits to accrue to emerging markets than to the developed. So that's why we're tactically overweight EM at this point.
Still, it's a big ask to get people to stay away from SPY, VU, or IVV. Katie, on this idea that the rest of the world is a better bet than the U.S. in 2020, the U.S. dollar, of course, is the big variable, isn't it?
Exactly. And, when I talk to people, I've heard a lot of bullishness for overseas assets, and that's usually coupled with the view that the dollar is going to weaken. And it actually feeds into this really interesting story about currency hedged ETFs. These products have done really well. In a lot of cases, they're outperforming their unhedged benchmarks, but they just haven't been attracting flows. 2019 was the 5th straight year of outflows. And again, they've been working because the dollar has been strengthening and doing well. So, I've been trying to get a sense of what the outlook is, whether this overseas bullishness is going to create a revival for these sorts of products. But mostly what I'm hearing is it's probably not going to look like the glory days of 2013, 2014.
Those products were rock stars. It was nothing. It was like a fad. I don't see it going back there, but we'll see. Some more outperformance could help. Speaking of fads, low vol was a huge hit last year. Everybody loves it. I love people who come on and challenge the status quo. You think low vol ETFs might not be the best thing for a portfolio now. Why is that?
So it really comes down to what you're looking to protect against. So if your concern is that there's going to be higher volatility and you could lead to some shorter term corrections, then sure, low vol will help to mitigate some of those risks. But if your concern is that there's going to be a severe prolonged downturn, then you could be better off in some other strategy like a trend following equity that tries to get out of equities to avoid some of the most severe drawdowns. So I think it really comes down to what are you trying to protect your portfolio for. It doesn't have to be an all or none decision, right? The more defensive strategies you have, the better prepared you are, because who knows what's going to trigger the next downturn.
Well, speaking of defense, ultra short duration had its heyday back in the early part of 2018 when the Fed was raising rates. If we get an unwind of the everything rally, these guys could be in favor once again. What else could benefit?
Sure. So if you're dealing with everything selling off, shorter duration, higher quality would stand to benefit in an environment where risk assets just more broadly sell off. And sure, you could have a scenario where higher quality or treasuries sell off too, but chances are the magnitudes are going to be much less, and you still would have been better off positioning and having some of those safe haven assets in your portfolio.
All right, David Perlman of UBS, thank you so much. Bloomberg's Katie Greifeld, great debut. Now coming up, Jan van Eck, CEO of Van Eck Associates, will be joining us as we dig into his ETF, Moat, a fund with active management type characteristics. And one ETF that caught our attention this week, State Street's Consumer Discretionary Select Sector Spider Fund, XLY. It's thriving. Last week, it saw a nearly $600 million inflow. It was the largest intake since September 2018 for this $16 billion fund. And by the way, you can catch that and all the other charts we feature on the Bloomberg at GTV Go. This is ETF IQ. I'm Scarlet Fu. This is ETF IQ. Let's take you through the ETF life cycle, which has three main stages. And step one is the filing. Paperwork for the Goldman Sachs Energy Infrastructure Enhanced ETF is now in. The passive fund will target U.S. and Canadian MLPs, midstream energy names such as gas distributors and oil and gas transportation and infrastructure companies. Step two is the launch. A quartet of Russell Investments funds debuts on the Toronto Stock Exchange. They are the Global Unconstrained Bond Fund, the Global Infrastructure Pool, the Real Assets Fund, and the Fixed Income Pool. Russell had launched a bunch of ETFs on U.S. exchanges back in 2011, but closed them all a year later. And for some, the final stage is liquidation. CHNX is no more. The passively managed CSOP MSCI China A International Hedged ETF invested in Chinese A shares while hedging 100% of the currency risk. Assets peaked at $3 million when it launched in 2015, but have been sub $2 million the last 3 years. Time now to get passive aggressive and track the tensions between active and passive investing. Looking for companies with specific competitive advantages that separate them from their peers, packaged in a fund with only about 40 names, which gets changed up every few months? Sounds awfully like an active fund, except that it's not. the VanEck Vector's Morningstar Wide Moat ETF. That's what we're talking about here. And I'm pleased to welcome Jan van Eck, CEO of Van Eck Associates. Great to see you.
Good to see you, Scarlet.
So let's talk a little bit about the shift from passive to active, or active to passive, excuse me. It's been happening for a long time. There's money also moving from active to quasi-active, which is kind of what you guys are. Do you see yourselves as moat, as smart beta, or quasi-active?
Definitely smart beta. I mean, I guess our whole philosophy of investing is the world is changing too fast to just stick with the market cap weight exposure as the only thing in your portfolio. So the wide moat fund, as you said, is very active underneath in the companies, because these companies, while they may be high quality, have good earnings potential, sometimes they get overvalued, sometimes they get undervalued. And that quarterly rebalance is really facilitated by the ETF structure.
Okay, and it's not growth and it's not value either. That's the other thing, because in smart beta, you tend to look at these specific factors.
Right, and we've done the factor analysis, and the outperformance, because Moat is a top quartile fund against both active and passive large cap core, that does not correlate with a growth or value risk factor. It's really stock specific that drives the returns.
Moat has become a franchise too, because you've got two sequels. You've got GOAT, which is global including the US,
right,
and MODI, which is international excluding the US as well.
Right, right. Well, Morningstar has 200 research analysts that do the earnings projections for all these companies to enable them to qualify as a wide moat, meaning they have a competitive advantage in that towards that earnings stream. And yeah, so they have global coverage with those analysts.
All right, now Moat's holdings, as you mentioned, are changing quite often, constantly changing in fact, because the annual turnover is about 56%, which means more than half of its holdings change yearly. For the S&P 500, the annual turnover is something in the neighborhood of 3%. So could this high turnover be a blueprint for the advent of active, non-transparent ETFs that are going to make their way to the market this year?
You know, we've been an active shop. Van Eck has been for over 60 years. And I think active managers are trained to be lower turnover because of the tax consequences. So for them to suddenly switch to a higher turnover way of thinking when they come in the office, I think will be a challenge initially for them. You're right, the structure completely enables that, but that's kind of a muscle that hasn't been used for a long time. So you know, hopefully it works out for them, but we'll see.
Do you think it could lead them astray, that temptation to be able to trade more often and to switch up the holdings?
You have to have like with anything active, as we do, you have to have a very strict investment process and a rationale for every way that you try to generate alpha or returns. And that if that's going to be a source of alpha, and as you point out, not negative alpha, they have to have a discipline around it, and we'll see.
Okay, one of the themes of our show this week is, of course, ESG, and you guys have an assortment of ESG-type products like SMOG and GRNB. You also have funds from the fossil fuel era, including Coal, KOL, which is for coal producers, and CRAC for oil refiners. Talk about the audience for each of these categories.
Well, I think, so when I think about ESG, I guess a couple of overall observations. G is governance. And it's at the heart of a lot of active strategies. So the thing is with ESG, are you just trying to match the market, or are you trying to generate alpha? And I do believe there's evidence that good governance and engagement with portfolio companies generates alpha. So that's one of the big differentiators. As far as E and S, or environment and the social, we have tended to favor environmental thematic, just like you mentioned. And so environmental services was actually launched the year we started our ETF business in 2006. And so yes, with respect to coal, you can short coal. With respect to nuclear, again, these are things that I think individual investors have their own value system, and they can put together a portfolio as they see fit.
I got to ask you about Bitcoin as well to get an update on the Bitcoin ETF approval saga. You guys filed for one, but then the SEC told everyone to withdraw their applications. Now, some analysts say the SEC's approval of an interval closed-end fund improves the odd for an eventual Bitcoin ETF. Do you agree with that take?
Eventual? Is it our lifetime? I mean, I think, you know, I agree with some commentators. I don't see a Bitcoin ETF being approved anytime soon. So, yes, vehicles that allow QIBs or accredited investors to access it, that's fine, but still you have tens of millions of retail Americans invested in Bitcoin with no regulatory protection.
All right,
That's
so
the
not
status.
necessarily anytime soon then. Jan
Right.
Van Eck, CEO of Van Eck Associates, thank you so much.
Thanks, Scarlet.
Now, today we're talking a lot about ESG investing, and it's all part of our new Bloomberg Green vertical, which is the focus on the scale of climate change. You can find all of our content on the terminal, online, and right here on Bloomberg Television and radio. Now, coming up, it is the Chinese New Year this week, and it is Year of the Rat. So next, we dig into an ETF that's getting into the holiday spirit. This is ETF IQ. I'm Scarlet Fu. This is ETF IQ. Now, for every ETF that offers exposure to a factor or a theme, others waste no time in following suit. When it comes to ESG funds, investors have their pick, more than 30 launches in the last 2 years to a total of more than 100. So let's talk to a firm behind one of the biggest ESG funds in the market, DWS Group. Luke Oliver is head of index investing there, but before we talk to him, Eric Balchunas is going to give us the drill down into DWS's fund.
Thank you, Scarlett. USSG, it's new, but it made a splash, and I'll tell you why. Because look at the assets in this, 1.7 billion, and it's basically a couple months old. So this is a big launch along with an iShares that a Finnish insurer seeded. So a lot of that money came in right off the bat. And look, the name looks like all of them, right? But what does it do? It's kind of in between one that goes hardcore after, say, the top 100 best scores in ESG, and one that just surgically removes a couple companies. It's kind of in between. So let's look at the holdings. What do you get here? The portfolio is going to look very similar to like the S&P, right? Except it's going to be missing some key stocks here, right? So take FANG. You're not going to get Facebook, Amazon, or Netflix, but you do get Google. You see you got Microsoft there. So you get some, you don't get some, and that's really what ESG is all about. What do you get, what don't you get? Let's look at the performance of this versus the market, and you can see it moves very similar. But you're going to deviate a little bit, again, because you don't have some of those FANG names. And right now, that's actually working. It's outperforming the market. But again, I would just, when you see this, that could reverse. So I think, Scarlett, the thing with these is you're going to have to just really look at the holdings. Do you want it? And compare it to the S&P.
Yeah, do your due diligence. All right, still with me is Luke Oliver of DWS Group. And Luke, ESG's group time has clearly arrived. There's a lot of buzz. People are doing their homework on it. Are they taking money out of vanilla index funds and putting it into ESG funds, or is it still mainly being seeded by big pension funds?
A bit of both. So we're seeing a big move towards ESG internationally. So a lot of international institutions are some of the big players behind these moves. And of course, they use US ETFs and US funds also. But we're definitely seeing that adoption now, more wholesale, more diverse. It's not just coming from those one or two big pension funds.
Let's talk about, okay, so what's in it? Okay, some people, like Nike's in it. Okay, well, okay, maybe they're fine. Something's not in it, like some of those FANG names. Berkshire Hathaway is in literally no ESG. Warren Buffett just not ESG-ish. What about this concept of throwing babies out with the bathwater? I mean, how many of these companies can you not hold and expect to outperform?
Well, that's part of the challenge with ESG. When you look inside this fund at the holdings, we aren't expecting you to say, oh, these are all green, environmental, social governance companies. You're supposed to look at it and say, this looks like a large cap core exposure to the US market. And in fact, then what we do is tailor that to make it more ESG friendly by filtering out. We take out some controversial firms at top level, and then we factor in USG for the top 50% of market cap.
And are people supposed to replace this with their whole equity position, or add it on because, hey, it's going to have the alpha down the road?
Well, something like this is a wholesale replacement. So you can add this to your exposure. We're not looking to give you, we're not presenting an alpha story off the bat. We're talking about positioning your large cap core price, core positioning, core sector allocations, but giving you something that you can use in place of that benchmark.
And of course, there's been a big jump in assets, as you were telling us earlier, but it's tiny when you compare it to, say, value funds or low vol funds.
Yeah, we just showed a chart showing that the average ESG ETF has 200 million. That's about a fifth lower than the average ETF, which is about 1.1 billion. You can see other categories. In other words, there's just too many products for the assets. How high are your hopes?
Very high. I mean, we've seen 24 billion, I think, is in US ETFs, the 100 or so that you mentioned, and we've seen that grow incredibly. 8 billion last year and 15 billion over the last couple of years. So there's a big increase, and what we're seeing now is adoption in the US. And I think part of that is coming from the trend is picking up. Secondly, the education is starting to kick in. This isn't about being activist. It's about having core exposure and doing so in a way that that is actually, there's not a conflict between being a fiduciary and investing in ESG.
What's the biggest risk to adoption? What's getting in the way?
Well, what was getting in the way is by either just including the really high-scoring ESG or just excluding whole sectors that you didn't like, your performance and risk look nothing like the benchmark. Products like this allow you to really have that core price, core allocation. So that is really going to go a long way. The tracking error to the benchmark are particularly low in these products. So I think that's where the adoption becomes less risky for people.
All right, Luke Oliver of DWS Group, head of index investing at the firm. Thank you so much.
Thank you.
Talking ESG. Now, it's a new year, new opportunities, and the opportunity now may be to protect the gains that you made in the last year. Check out this week's There's an ETF for That.
The year of the rat is upon us, and according to the Chinese zodiac, the rat brings with it a focus on wealth and surplus. The Cambria Tail Risk ETF seeks to maintain investor wealth by mitigating significant downside market risk. Trading under the ticker TAIL, the fund invests in a portfolio of out-of-the-money put options as a hedge, since they gain value when the U.S. stock market falls. TAIL is not all about options, though. The bulk of the fund is actually invested in a treasury bond. The fund has attracted some $75 million in assets and has an expense ratio of 59 basis points. Because TAIL is designed to hedge against market declines and rising volatility, Cambria says the fund will often produce negative returns in years with rising markets or declining price swings. And that's exactly what's happened, with TAIL in the red since launching in 2017, in contrast with the S&P 500 soaring to record highs. TAIL gets a green light in the Bloomberg Intelligence traffic light system, with one warning for its actively managed status.
The concept is there, but it can get painful waiting for that everything down scenario.
Oh, there's so many products just lying in wait for things to get bad. They're like insurance, right? And that's one of them. And I think they could have a good run when things go bad, because remember, that's, people are going to look for an umbrella after it rains. These are the products that are sort of like selling them outside of Penn Station.
Problem is, it doesn't rain that much these days, and when it does, the sun comes out.
Yeah, it's like
almost
California. The
immediately.
market's like California. Yeah, it just barely rains. So, but
in fact, it just gets sunnier.
Yeah, at some point it will, though.
All right, see, we linked it back to climate change once again.
Right.
That does it for Bloomberg ETF IQ. Be sure to catch us each Wednesday at 1 p.m. New York time, 6 p.m. in London. From New York, this is Bloomberg.